Hello everyone, this is your James AG. Good evening, and welcome back to the channel. If you're here, you already know this isn't hype season. This is your James AG. We're not chasing momentum. We're monitoring system stress, which means we watch the plumbing, not the ticker. And tonight, the plumbing is screaming. Before we look at the data, and tonight, the data is genuinely extraordinary, I need to clear the deck. There are fake accounts across every platform impersonating this channel, sliding into DMs, asking for payments, offering exclusive signals or VIP allocation lists. Let me be absolutely explicit. I will never ask you for money. I do not manage capital. I do not sell courses, signals, or private groups. I do not have a WhatsApp trading desk. I do not send payment links. If someone messages you claiming to be me, block them immediately. This is the only channel, and the only communication happens right here, in public, in the comments section below. No exceptions. Second, nothing you hear tonight is investment advice. I am not your financial advisor. I am a macro analyst documenting systemic dislocations. You are responsible for your own decisions, your own risk tolerance, and your own verification of every data point I present. If you're looking for someone to tell you what to buy, when to sell, or how to trade, this is the wrong room. This content is for serious, independent thinkers only. If you're here for Lambo memes, price prediction theater, or guru worship, you're in the wrong place. This channel is for people who do their own research, who verify institutional data, and who understand that precious metals are strategic assets, not lottery tickets. If that describes you, I need you to do two things right now to help the algorithm reach the others who need this information. First, drop OG in the comments. Let me know you're here, you understand the stakes, and you're part of the community that thinks independently. Second, drop your location, city, and country. I want to know where this signal is reaching. Are you watching from Toronto, Singapore, Frankfurt, Sao Paulo? The geographic dispersion matters because what we're seeing tonight is a geographic arbitrage event that spans London, Shanghai, and New York. Knowing where you're positioned helps the community understand the real physical market footprint. Tonight is critical. The Asian opening in a few hours, Sunday evening Eastern Time, could determine the trajectory for the entire quarter. We're standing at an inflection point where the paper pricing mechanism is colliding violently with physical reality. Margin hikes, inventory exhaustion, and geographic premiums tell us the system is under maximum stress. But we don't panic here. We map the terrain. We look at the CME data, the Shanghai premiums, the dealer inventory reports, and the COT positioning. And we do it with discipline, not fear, not greed. So if you're ready to look at hard data instead of narratives, if you're ready to understand why the paper market is showing $85 silver while physical sourcing has effectively halted in multiple jurisdictions, stay locked in. Verify everything I'm about to show you. Cross-reference the COMEX margin circulars. Check the Shanghai Gold Exchange closing premiums. Look up the dealer inventory notices yourself. This is your responsibility. Tonight, we watch the Asian Open together. Because the divergence between paper and physical isn't theoretical anymore. It's happening now, in real time. And Monday's session could be the catalyst that forces convergence. Here is the abnormal event you need to understand before Monday's Open. The CME Group issued a margin circular on Friday, effective at the close of business today, Monday, February 2nd, 2026, that raises maintenance margins on gold futures by 33% and silver futures by 36%. This is the second hike in 3 days. Combined with the adjustment earlier in the week, the cost to hold a single COMEX silver contract overnight has effectively doubled since Wednesday. Think about what that means for a moment. We are not talking about a subtle adjustment for volatility. We are talking about a forced liquidation trigger baked into the system at the precise moment when open interest was already strained, when delivery notices were stacking up, and when the paper market was reeling from a 31% single-day collapse in silver on January 30th. A record drop that brought COMEX silver prints down to approximately $85 while the physical world watched in real time. But here is the dislocation. Here is the why is this happening there but not reflected here that defines tonight's risk. While the paper price on COMEX prints $85, the physical market in Shanghai closed Friday at approximately $122 per ounce equivalent, a 43% premium. JD.com, one of China's largest e-commerce platforms, lists deliverable silver bars at $163, representing a 91% premium over the COMEX paper settlement. In London, Baird & Company, a historic refiner and dealer, has suspended online sales entirely. Golden State Mint in the United States has halted new orders. Bullion Star, the Singapore-based dealer with deep regional connections, is reporting uncertainty about acquiring new inventory at any scale. So I need you to sit with the asymmetry for a moment. The paper market says silver is worth $85. The physical market says you cannot have it for less than $120, $140, $160. And even at those levels, the dealers are closing their doors. Why is this happening? Because the margin hikes are not occurring in a vacuum. They are hitting a market already suffering from delivery stress. When the CME raises margin requirements by 36% overnight, they are not targeting speculators to cool off the market. They are force liquidating leveraged longs who cannot meet the new collateral calls. This creates a feedback loop. Falling prices trigger margin calls trigger forced selling triggers lower prices, which trigger more margin hikes. But this feedback loop only functions in the paper derivatives market. It does not function in physical reality. You cannot force liquidate a solar manufacturer in Jiangsu province that needs silver paste for photovoltaic cells. You cannot margin call a central bank adding to strategic reserves. You cannot algorithmically dump the inventory that isn't moving through the LBMA pipeline because refiners are already running at capacity and miners cannot accelerate extraction of a resource that takes a decade to bring online. The geographic arbitrage tells us everything. If the $85 COMEX price were real, if it reflected actual metal availability, you would see that metal flowing immediately to Shanghai to capture the $40 plus arbitrage spread. But the metal isn't flowing. The warehouses aren't releasing. The dealers aren't restocking. Instead, the premium in Asia is widening, and the availability in the West is constricting. This is the definition of a bifurcated market. The paper pricing mechanism is breaking down because it is being driven by derivatives leverage and forced liquidation cascades, while the physical market is decoupling because you cannot print silver to meet a margin call. You either have the molecule in the vault or you don't. And tonight, Sunday evening Eastern Time, the Asian markets open first. Shanghai, Tokyo, Sydney. These markets are predominantly physical settled or physically referenced. They are not playing the COMEX margin game. When they open, they will look at the $85 print from New York. They will look at their own emptying warehouses. They will look at the industrial orders piling up from the AI and solar sectors. And they will have to make a decision. Does the physical market accept the paper price as legitimate? Or does it reject the premise entirely and force a convergence at much higher levels? Or via physical premium only, effectively breaking the price discovery mechanism we have relied upon for 40 years. The urgency tonight is not about predicting whether silver will be $90 or $130 by Tuesday. The urgency is recognizing that we are watching a structural dislocation in real time. We are watching the moment when the paper market's ability to suppress physical reality through leverage and margin mechanics reaches its hard boundary. Monday's session is not a normal trading day. It is a stress test to determine which market, the leveraged derivative casino in New York or the physical industrial hub in Asia, gets to define the price of a strategic metal in a supply deficit. Let's examine the institutional tape, not opinions, exchange-reported figures, warehouse receipts, and regulatory filings. First, the COMEX inventory structure. As of the latest CME warehouse report, we are witnessing a critical divergence between eligible metal, stored in approved facilities but not available for immediate delivery against futures contracts, and registered metal, officially available to satisfy delivery notices. Registered silver has been draining consistently, while eligible stocks remain static, suggesting owners are pulling available metal out of the delivery mechanism entirely, either to move it to private vaults or to ship it to Asian markets where premiums justify the logistics cost. This matters because the open interest in silver futures remains elevated relative to deliverable supply. When you divide the registered inventory by the number of outstanding contracts, you get a coverage ratio that has fallen to levels last seen during the acute stress events of 2020 and 2008. The exchange is not running out of metal categorically, but it is running out of metal willing to be delivered at the paper price. That is the definition of a liquidity crisis in a futures market. Not zero supply, but zero supply at the printed price. Now look east. The Shanghai Gold Exchange closed Friday with silver trading at a 43% premium to COMEX, approximately $122 per ounce versus the $85 print in New York. The SGE is a predominantly physical market. You cannot settle these contracts with cash equivalents or EFPs, exchange for physical, loopholes indefinitely. If you take delivery in Shanghai, the metal leaves the vault. This creates a gravitational pull on global inventories. When the spread covers freight, insurance, and tariff costs with substantial profit remaining, metal moves. And when it moves, it does not return to the Western paper sphere quickly, if ever. The MCX in India tells a similar story. Local premiums have expanded despite the rupee's volatility, indicating that physical arbitrageurs are importing aggressively, even as the paper market crashes. India is traditionally price sensitive. When Indian buyers chase metal into a falling paper price, they are signaling that the local physical market has decoupled from derivative-driven volatility. Turning to the CFTC Commitment of Traders report, specifically the Bank Participation Report and the disaggregated COT, we see a structural repositioning that confirms the dislocation. The commercial net short position in silver had reached historic extremes in late January, driven primarily by swap dealers hedging OTC exposure. However, during the collapse to $85, we observed significant short covering by the largest concentrated positions. Institutions with the balance sheet to warehouse physical metal were covering derivative shorts at the exact lows, effectively locking in the spread between the $85 paper print and the $122 physical reality. This is not conspiracy theory. This is position reporting. When the largest players are covering shorts into a margin hike-induced liquidation, they are signaling that they view the paper price as temporary dislocation, not fundamental repricing. They are capturing the arbitrage between the leverage-punished paper longs and the physical offtake in Asia. The Silver Institute's latest supply-demand data provides the structural backdrop. We have now seen 9 consecutive months of global market deficit, where fabrication demand, photovoltaics, electronics, automotive, has outpaced mine supply and scrap recovery. Solar sector alone is consuming approximately 15% of annual silver supply, growing at double-digit rates year over year, while mine-grade degradation and reserve depletion constrain new supply response. A textile mill cannot hedge solar panel production with COMEX futures. They need physical delivery, and they are paying the $122 Shanghai price to ensure continuity of production. The liquidity risk in the futures market is now acute. With the second margin hike in 3 days, 36% for silver, the CME is explicitly targeting the leverage embedded in the paper market. Each margin increase forces liquidation of undercapitalized long positions, which in turn pressures the spot price lower, which triggers more margin calls. This is a classic short-term liquidation cascade. But observe the inventory data. The price is falling while available registered metal is also falling. In a healthy liquid market, price declines coincide with inventory builds as weak hands sell physical into the dip. Here, weak hands are selling paper claims while strong hands are removing physical from the exchange. The divergence confirms that the futures market is no longer the primary price discovery mechanism for physical silver. It has become a leveraged betting instrument disconnected from the underlying commodities flow dynamics. When 43% premiums persist across the Pacific, the price signal is broken. The question for Monday is whether the margin hike liquidation has exhausted itself, or whether the Asian opening creates a bid so aggressive that it forces a reconciliation, either through an explosive repricing in New York or through a permanent separation where COMEX continues to print fictional numbers while Asia defines the real clearing price. The data says the latter process has already begun. A brief note on the chart structure, strictly for market context, not trading instruction. The daily relative strength index for silver has plunged into deep oversold territory following the January 30th washout, printing below 25 on most standard settings. This level historically coincides with exhaustion selling, though oscillators can remain extreme during forced liquidation cascades. Of note, if the price prints marginal new lows into the Asian Open, while momentum indicators form higher lows, we would have bullish divergence, suggesting the paper selling is mechanically driven rather than fundamentally motivated. Price action has violently separated from the 200-period moving average on both daily and weekly timeframes. The $85 handle represents a nearly 3 standard deviation downside extension, a statistical anomaly that typically reverberates back toward the mean, though margin mechanics can override mean reversion in the short term. The 50-day moving average now sits approximately 25% above current prints, serving as technical overhead should the market stabilize. Ichimoku cloud structures have flipped bearish, with the Tenkan-sen crossing below the Kijun-sen and price action penetrating the cloud bottom, though cloud projections lag significantly in this volatility regime and should be weighted accordingly. Volume profile analysis reveals the January 30th decline occurred on exceptional relative volume, 3 to 4 times the 20-day average, suggesting capitulation or forced liquidation rather than organic distribution. The volume node between $95 and $105 represents the last area of structural accumulation. Below $85, the profile thins considerably, indicating a potential air pocket where liquidity becomes sparse. Observe these technical levels only as markers of market structure, not as signals to trade. In an environment where paper pricing diverges from physical reality by 40% or more, technical indicators derived from futures price action measure derivative sentiment, not commodity scarcity.